Hey everyone, in today's video, we're going to be looking at 8 stocks that just hit their 52-week highs. We're going to be looking at what these stocks are, what recent news propelled these stocks to their 52 weeks high, and then we're also going to look at valuations. This year, next year, what kind of price to earnings ratio are these stocks trading at? Are they stocks that are trading at attractive valuations even though they're at 52-week highs, or do I think that each of these stocks may have run up a bit? We're going to get into that throughout this video. Jumping into stock number one, Meta Platforms. Meta has been on an absolute wild ride the last number of years, went all the way up to $400 a share pretty much during the pandemic, and then went all the way down under 100, about $90 a share. Since then has rallied over 200% up to its 52-week high here today, hit 298, closer to 295. So we're going to look at this company on a $750 billion valuation, what their earnings look like in a minute. But before that, a couple of the things that drove Meta to get to these 52-week highs. I think the first thing was just the sentiment by Mark Zuckerberg on 2023 being the year of efficiencies, lowering headcount, right-sizing to some extent investments in the metaverse. In addition to that, it looks like investors really like Meta's play to launch Threads and go after Twitter when they have some weakness in their consumer base and the public narrative around the company as of late. So as they've got closer and closer to launching Threads, the stocks rallied a bit. There's potential for good news to come out if they say on day one X millions of people downloaded the app. Maybe we'll see a bit of a stock jump in the stock rather. And then looking from an earnings standpoint, if I look at just this year, they're going to do about $12 in earnings per share. So that puts it at about a 25 times multiple at these valuations. But if I look next year at about $15, they're closer to about a 20 times multiple. So trading 20 to 25 times, that's even with all the money they're burning on Reality Labs. If you strip that part of their business out, they're probably trading under 20 times forward earnings on this name. So my overall thoughts on Meta, it's really run up. I actually bought more when it was around 100, added to my position that I have on Meta because I did think that their core business was being undervalued, even though I didn't like the direction they were taking with the metaverse. But, it's really ran up here, and at $300 a share, its margin of safety has definitely been priced out. I can see if they, have a bad quarter, the stock going down double digits in a day. With that being said, long term, they have a lot of potential to be a big part of the future with technology. So this is one that I'm going to continue to hold. I don't think it's at a steal of a valuation at 20 to 25 times, but also, some potential here if you believe in the future of the company. May not be a terrible spot to get in relative to where some of their price to earnings were in their past history. So this is one that I'm kind of lukewarm on. Own the stock, like the stock overall, but yeah, it's definitely fair valued, I'd say at this point. It was undervalued before. It was probably overvalued at a time, but I think it's probably pretty fair where it's sitting here around $300 a share, 20 to 25 times earnings. Stock number two is Carnival Cruise Line. Talk about stocks that have had a wild ride. This one's still down about 67% for over the last 5 years. Right before the pandemic hit, this one was trading for about $50, and then soon after went all the way under 10. Had a really hard time recovering, but you can kind of see here up over 140% year to date, which is crazy. There's just been a really positive sentiment around travel and lots of consumers, despite maybe some macroeconomic headwinds, not cutting out travel spend, and especially these older consumers who are more baby boomers, having tons of money saved up, not even sure what to do with it. They're booking cruises farther out. The cruises have pricing power right now. As we look at some other comments here, lots of banks every week keep upgrading all of the cruise stocks. You can see that really propelling the valuation, even if I go the last month, up 50% alone in the last month. So huge value being created here. But yeah, JP Morgan upped. Lots of other analysts also up. Bank of America upped. So lots of just positive rhetoric around the cruise space as they rebound from COVID. I would caution people who think they're going to get back to $50. They did launch a lot of new debt, diluted a lot of shareholders with new shares. So to get back to that $50 is going to take a higher overall market value and enterprise value than the company had before, unless they start aggressively paying off debt, buying back shares. So just be careful on this one. In terms of EPS, I think I talked this in a prior video, but they're expected to be flat to down this year, make about $1 next year. That means they're going to make about 19 times forward earnings. For a company like this with the debt and the leverage they have, I think that's expensive. So I'm not going to be going into the cruise space anytime soon, but at least some relief for these shareholders. Gives maybe some people an opportunity to get out if they bought during the last few years when the stock was low on this 50% run up in the last month. But overall, I'm definitely not buying into this news. The third stock that just hit a 52-week high here today, as you can see here on the right-hand side at 227, was Lowe's. And this one actually surprised me because the Home Depot, if I can just get that up briefly, I think they had lots of issues and missed a couple of quarters. So you can see Home Depot is about 10 to 15% off their 52-week high. And I used to think Lowe's and Home Depot really moved in lockstep, but it seems Lowe's is disproportionately winning as of late. Looking at some of the commentary around it, it shows how Lowe's has actually risen this year disproportionately versus their sector. They delivered strong earnings, they increased their dividends, and lots of analysts have upgraded them as a result while downgrading Home Depot. So a lot of positive momentum for the Lowe's business. Looking at earnings per share, has $13 here, and then about 7-8% growth for next year. So $13 of EPS. This company's trading for about 18 times current year on EPS, and then closer to 16 times next year's earnings on EPS. So, some risk in this space overall, just as maybe consumers bring in their spending a bit. But I think a fair valuation on this one for an entry point. Looking at the stock over the last 5 years, it's nice that even that it's at a 52-week high, you are getting it at a bit of a discount, call it 7, 8, 10%, versus its all-time peak at the end of 2021. So that's at least something for those people who are looking to get in the stock but don't want it at an all-time high. Even though it's not a 52-week high, there was still a time people were buying the stock for closer to $250. Okay, going into what I believe is stock number 4 here, and it is FedEx. FedEx here just hit $250 a share today. Looking at this company in the last year, up 9%. Year to date, though, up 40%. So that means there must have been a huge dip on earnings in September, bringing the stock down massively, and it's just rallied quarter over quarter over quarter over quarter ever since, delivering that 40% upside on the year. They do pay a 2% dividend. Looking into their earnings per share a bit, expected to do $17.50 this year, $21.60 next year. Really strong growth here. That's almost 20% earnings growth anticipated. So let's say $17.50 and $20. On $17.50, this company is trading at around a 16 times, and if they actually get to $20 next year, that'll go down all the way to 12 times. So interesting stock. Once again, similar to Lowe's, it's at a 52-week high, but if it gives you any peace of mind, it's trading down 20% from its pandemic high. So you're getting a bit of a discount versus at least the people that were buying up at the top. And the valuation on this one is, I think, pretty in line with what FedEx has been historically. So I don't think you're getting a steal. This company has a lot of tailwinds, also some headwinds, especially with competition. So it's an interesting stock, interesting company. I think it's fairly valued in kind of the mid-teens given what it is. So congrats to people who've rid it up to the all-time high. I don't think it's in a bad position where it is now versus relative to where their earnings are going to come in and the type of market they play in, but also not a steal by any means. So still trying to find a steal um, at the 52-week highs. And at the end of the video, I'll let you know which ones I think are the best value in my opinion. MasterCard. So MasterCard also hit a new all-time high of $395. Looking at this one over a longer period of time, I also think this was an all-time high. I don't think they've ever hit $395 before. Looking at their earnings per share here, expected to do $12 this year, $15 next year. At $15, this stock is trading at about 27 times next year's earnings. So expensive stock. Seems slightly more expensive than MasterCard by 1 or 2 times on the multiple. So they're probably outgrowing them slightly, getting a bit of a premium on that. I do own MasterCard, Visa in my portfolio, not MasterCard, but I think the two both hit all-time highs today, and they both are playing a very similar game. So my play into its Visa. This is MasterCard, both great companies. Both, I believe, are going to continue to benefit from cash to card transition, as well as cross-border and other things as well. So I think these companies are really well positioned, have great moats, have essentially a royalty on the global economy. Love to own my Visa position. I think MasterCard's equally a great company. And even at 52-week highs, I think it's not a terrible place to buy it at 27 times next year's earnings. Okay, going into, I believe, stock number 6 here, and it is Walmart. This one was interesting, especially as we see all the challenges that some of their competitors. Going to check out Target here quickly, down at $132, which is significantly lower than their 1-year high. If I look at the dip from the high, they're down almost 30%. So interesting to see just how different it is across the retail sector in terms of stock market performance. Year to date, up 10% on Walmart. In the last year, up 26%. So despite inflation, grocery prices going up, seems like their margins are doing just fine, and they're passing those cost increases along to the consumer, and the consumer is buying it. Maybe more consumers migrating into Walmart from higher end retail stores as they're trying to save money. Whatever the equation is, it's working really well for them at $159 a share that they just hit today. At its 52, and I think likely all-time high as I look at this longer chart. Looks like they got only up to 157 last time. So we'll see if this keeps riding for Walmart, but this one was one, as I've heard of all the challenges with theft and shrink that Walgreens and all these other retail companies have had. I was pleasantly surprised that Walmart was actually at a 52-week high here today. Okay, going into stock number 7, it is Delta Airlines. So this follows a very similar realm as Carnival that we talked about earlier, with people still wanting to travel, people traveling more. Business travel is a bit more ambiguous, I'd say, still, and still coming back, but personal travel is flying off the charts, and Delta is a direct beneficiary of that. You see them here, 50% year to date, over 60% in the last 12 months, just hit a 52-week high of $48, almost $49. If you look at some of the things that the company's done here, some key points from the Motley Fool on what's really driven the stock over the last month. They declared their first dividend, so that's a huge sign of optimism from the leadership team on their cash flows in the future. They provided strong guidance at their investor day that always performs well or translates well to the stock price. And while they're not exactly back where they used to be operationally before COVID, they've made it clear that it's a huge priority and that they're making strides in the right direction. So that's all great stuff to see. Looking at the earnings per share here, expected to be $6 this year, $7 next year. You can do the math yourself. You're essentially planning on doing about 8 times earnings for this year and 6.5 to 7 times earnings for next year. Seems like a great value if those EPS numbers are true and CapEx is adequately being accounted for in terms of the kinds of investments the company has to make on a year-over-year basis. So even though this one's at a 52-week high, seems like there's some potential with it still. Going into Netflix, so this is the last stock here that's at a 52-week high that we're going to be talking about. Stock 8 of 8, similar to Meta, some other stocks. This one's had a wild ride, and I feel like Netflix in isolation, you can learn a lot from kind of what took place, the disjointedness of the market versus the actual performance of the company. Transparently on the way up to $700 a share, definitely on the way down to $150 a share. And now it's just rallied from there up another 150%. And these aren't small cap companies moving. These are $200 billion companies adding tens of billions of dollars in a couple of months. So really amazing stuff here. As we look at this company year to date, up 50% on Netflix. There is so much news going on. The first one is bullishness around password sharing crackdown, going to get more new users on the platform conceptually or hypothetically. So we'll see how that plays out. Their ad tier model, which seems like it came off to a slow start, but they're really committing to ramping it up. And they've just had a ton of pricing raises, target raises as a result, which has really helped propel the stock as well. Looking at earnings per share, expected to do about $11 this year, $14 next year. As I translate that to their stock price, that means I'd expect them to do about 40 times earnings this year, and then next year closer to 30 times earnings, give or take. Still a very expensive name, especially when you could have bought it for 15 times earnings during that huge dip that we saw at the beginning of 2022. So, this is a great example of Netflix has always been a great company, but that doesn't mean it's always a buy. Up here at $700, I actually sold on the way up there. I actually had some Netflix shares, but it was just getting ridiculous what the present value of the cash flows were going to have to be, or we're going to have to be in order to justify that free cash flow return and the net income that the company was spitting out. Then you come all the way down there, and it looks like most of the risk is taken out. Now, similar to some of the stocks we looked earlier, it's kind of found its midpoint. And I say midpoint somewhat facetiously, since it's back up to almost $500 a share. At $200 billion, it has a significantly bigger market cap than Disney, which is only at 164, so 20% bigger than Disney just for a streaming service. So this company has a lot going for it, a lot of momentum, but we'll see if they can pick it up into next year. But for now, they are at a 52-week high, trading 40 times earnings. Okay, so just to wrap up, some of the stocks here that interest me the most. Meta, I think, is great to have a small position in. I'm not really adding to it because I already have a pretty strong position in Meta that I've built up over the years. Lowe's, I think, is trading at a reasonable valuation. MasterCard, just great long-term business over time. Never really a bad time to get into it. I think they'll appreciate over time. Delta, I need to do more research, but if those price to earnings ratios are correct, trading at a significant discount versus some other airlines that I've looked at. So despite me fishing from 52-week highs here, still tons of opportunities here. It's a good reason why lots of these companies are at highs. Hopefully it serves as a lesson to not dismiss companies if they've gone up in your portfolio, or if they've just gone on a bit of a run and you're considering them now for your portfolio. So I hope you like this type of content. If you made it all the way to the end of the video, be sure to give this video a huge thumbs up. Also, let me know in the comments that you did. We don't get too many people making it all the way to the end, so I really do appreciate it. If you like this type of content, subscribe to the channel, and everyone, please like the video for more. It really does help with the YouTube algorithm. I'll see you guys in the next one.